More layoffs at Seattle-based Starbucks. Hundreds of workers are losing their jobs, with many refusing to relocate out of Seattle.
A new filing shows 104 of those jobs are in support roles, but also 120 workers who declined offers to relocate to its new Nashville office.
Starbucks just laid off 120 employees that refused to move to Nashville. This as demand continues to fall double digits in Nashville. And the question I have, are we witnessing one of the biggest shifts in migration since 2021? To get some insight, I reached out to Eric Finnigan of John Burns Research and Consulting.
What we've seen with migration really all over the country, not exclusive to Nashville, fewer people are moving across state lines, moving to different regions, previously hot migration markets. So the boost to housing demand from domestic net migration is half of what it was in 2021.
But there's something not quite adding up. If people are choosing to stay in Seattle and not move to Nashville, then is Seattle's housing market doing better?
A shaky tech industry is now hitting our local housing market.
Pending home sales have taken a bigger dive in Seattle than any other U.S. region, according to Redfin. Como's Claire Weber is live in Seattle to explain the numbers. Claire?
Kelly Preston, to put it simply, Seattle is a tech-driven housing market, and a slowdown in new jobs here has meant homes are sitting on the market for much longer.
When we look at the markets feeding Nashville's inbound migration, Seattle is one of the worst housing markets in the nation, and yet it's one of the larger drivers of domestic migration to Nashville, along with San Diego, San Jose, Atlanta, Los Angeles, New York, Washington, and Chicago. Of all of those, only 3 are outperforming the national average in pending home sales, and the national average is also going down. Could there be another driver behind this massive drop in demand?
On the national headlines, you have Starbucks moving jobs to Nashville, Oracle expanding there, Paramount talking about going there. So I feel like in terms of where companies want to go, Nashville's maybe as hot as ever, whereas as you've pointed out, Nashville still seems to be struggling.
Year-to-date sales over $1 million are up 14.5%, where the rest of the market under $1 million is flat. This indicates that there is a wealth migration narrative that's still intact, but it doesn't explain what's happened over the last month. If pending sales were slowing down due to a massive decrease in migration, we would also see that in a slowdown in higher price bands. When we look at contracts by price band, what we see is the lower you go in single family, the worse it is year over year in terms of demand. In fact, homes priced under $300,000 are down 25% in demand. And before you think this is a supply story, supply is growing the fastest in that price range. We are starting to see a bounce back in demand in condos, but these pale in comparison to the demand volume of single family. So even if condos are up 12%, single family being down 12% means that Nashville's entire housing market is down in demand 10%.
July was certainly tough, and I think July was oil and interest rates backed up again. And so buyers see, mortgage rates just moved 30 basis points. I'm going to sit back and wait for a few weeks, see if things settle down. August, the stock market's been better. We haven't seen housing demand bounce back yet. I'd be surprised if we get a sustained pullback like we've seen over the past 6 weeks, but it's certainly something we'll be watching the data. So I think I want to see how September and October go.
That was Conor Sen, formerly at Bloomberg, now starting a new Substack called The Housing Frame. On the active listing side, single families are up 8.3%. Still yet to make a new high in active listings that we saw in July. This surprised me a little bit. It seems as though seller motivation isn't quite where I would expect it to be, given just how bad demand is. Price cuts as a percentage of active listings still trending up. We'll see if it continues going higher than it did last year at 41%, but so far we're not there yet. Now, some of you have asked about the relistings and how that relates to the price cuts. And I think this is a great question. How many are cutting their price and it's hidden in the active listing space? We have 488 listings that were new this week that happened to be either a failed contract or relisted from a withdrawn and canceled previous listing. Of those 488, 207 are now at a lower price. This would not be counted in the price cuts as a percentage of active listings. So just keep in mind that it is undercounted when we look at that percent metric. When we look at prices on a median basis, what we see is the median under contract price is right in line with where it was last year. If we look at single family, it's actually up a couple percent, but basically flat. If we look at median contract price per foot, what we see is it's 0.8% higher. It's basically flat.
Unemployment is pretty low still. Not a lot of people are losing jobs. So just the urgency to move, urgency to sell it's just not there.
If the urgency to sell is not there, even as listings grow, sellers should be way more motivated than they are. But Conor said something so quickly that made so much sense.
Private sector employment is getting better. And so I think, jobs equal housing.
With the optimism around Starbucks and Amazon and Oracle, and even now buzz about Paramount moving to Nashville, it seems like sellers, they continue to hold out in most areas where the cost to hold is low. This is why some of the largest drops in values aren't coming from single family where there's a low cost to hold, but it's coming from areas where there's a high cost to hold and there's new build competition. A perfect example of this is downtown, where we have the 1212 condo right across from the Pullman, a new build condo conversion that has been selling off hundreds of condos. And what we see in 1212 is that it's so clear when we look at the drop in price starting at about June of 22, which again was where we had the interest rate spike and people listed their condos for sale, and it just became harder and harder to hold on to them. What we see is a consistent drop in value, all the way from $800 a unit at the peak in June of 2022 for a smaller unit down to $495 a foot today. That's a $300 a foot drop. That's a 30 or 40% drop. There was a high cost to hold and there was new build competition right across the street. So if you are looking for areas where home values have dropped, those are the two key ingredients where we see over and over again they have dropped. Unfortunately, though, we are still seeing a tug of war between buyers and sellers. Buyers have taken a significant step back, but in most areas, single family continues to hold out. Sellers continue to be less motivated than I would expect them to be given the market conditions. That being said, we'll see if anything changes this fall. Special thanks to Conor Sen and Eric Finnigan for joining me this week to help me unravel some of the mysteries of the housing market. With that, I hope you all have a great rest of the day. I look forward to seeing you next Saturday. Thanks for watching.